Despite several headwinds that impacted the NBFC segment, L&T Finance has managed to post a decent profit growth in the second quarter. The company also continued to post a steady growth in its rural and housing lending businesses. However, the company's exposure worth 800 crores to Supertech. How will this impact the financials going ahead? Let's find out from Mr. Dinanath Dubhashi, he's Managing Director and CEO of the company. We also have Shraddha Babla from our research desk who joins in right now to take the conversation forward. Shraddha, over to you.
Well, good morning, Mr. Dubhashi. Thank you for joining us. I understand that it's been a good quarter in terms of growth, but given the current operating environment, do you similar growth rates for the financial year?
All right, I think there is a slight bit of an audio issue with Shraddha's mic. We'll try and get that fixed. But just before we go across and get in a sense of how the quarter shaped up at L&T Finance, I just want to take a look at the current market situation. It's not worsened. In fact, you are seeing a little bit of stabilization at these levels. 10,131 on the Nifty is where we are currently perched at, with the banks showing a slight bit of an outperformance. Remember, overall, banks as such in the last few days of trade have been outperforming the benchmark indices at least. But L&T Finance, if you could just have the stock price before I toss it back to Shraddha, we can take a look at how the stock has been performing. But concerns there are a little bit more large in terms of the kind of exposure that they have to some of the companies in question. Shraddha, over to you.
Right. Okay. So, Mr. Dubhashi, I understand it's been a good quarter. My question is if in the current operating environment, similar growth rates can be replicated for the rest of the financial year.
See, it depends on where you are growing, right? If you see our growth, the most important part of the growth, why this quarter and why current environment? We have continuously grown more in rural and housing, which are much more granular businesses than infrastructure, which was at some point of time 66% of our assets. Now it is down sizably, and rural plus housing is now at 47%. So given that, we believe that there are opportunities of growth, especially in rural and retail housing, where the risk perceptions are also quite good. We are also making sure that there is enough liquidity available to continue that growth. So we would believe that growth in rural and retail housing can continue unabated, both from the risk point of view as well as available liquidity point of view.
So you're saying that the growth will be driven by rural and mainly your retail businesses, that is rural and housing. But on rural, we've been hearing that the growth as far as two-wheelers and tractors are concerned, the growth has been moderating. And again, your housing finance business is essentially builder financing and LAP. And those are the two segments where you have been slowing down disbursements consciously. So then how will it be supporting 20-25% sort of AUM growth?
I will explain this. So number one, first, let us see where the growth is coming from. Or rather, let us see where our performance has come from. Our performance has come from very simple things. One, growth in our core areas. Two, maintaining of NIMs and fees. Three, keeping costs low. And fourth, most important, is keeping continuous improvement in credit quality. So sticking to basics, no rocket science. That is where performance has come, and that is where we are reporting the 66% growth in profit and 18.47% ROE. So that's number one. That's just putting the framework in place. As far as growth opportunities are concerned, rural, of course, the 70% growth that you are seeing is because of a base effect. You don't need that kind of growth to to show a steady profit performance. We expect that over the next 3 to 5 years, rural business, whether tractor grows sometimes or micro loans or two-wheelers, this will vary from year to year. But over the next 3 to 5 years, a CAGR of between 15 to 20%, even if it is maintained, the overall profitability can be easily maintained. One, coming from productivity increase, and second, coming from increase in fees. Third, coming from further improvement in credit quality. So, to answer your question, the 70% growth that we have shown in rural is obviously one time. It is a base effect because last year we were just coming out of the demonetization, but that kind of growth is not needed to keep profit engine growing. Second, about housing, you would see that our retail housing though overall housing is flat, that is because of negative disbursement growth in LAP and even in builder funding, a small negative increment. But the retail housing, there is a strong positive growth. Within that also, the percentage of direct sourcing and the percentage of salaried has increased. So the basic framework, the growth framework of retail housing home loans has improved, and we are confident that we will be able to scale it up. Lastly, you talk about builder funding. Yes, it is one of our core businesses. We have differential knowledge, a differential way of managing our exposures based on our pedigree, learning from our group L&T. And based on that, we have very project-based, safe, A category and strong middle and late stage project exposure in this area, and pretty sanguine about our exposure in construction funding, even in the so-called current scenario.
Okay, so you're saying that a 20-25% sort of a growth in consolidated AUM is still doable for FY19?
Okay, maybe not 25, but yeah, closer to 20 is what we have been guiding always. And that should be possible even in FY19 and FY20.
Okay, so L&T Finance has an exposure of about 1,800 crores to some of the IL&FS transportation SPVs, and also another 800 crores to 3 projects of Supertech. What are the kind of provisions that you've made against these accounts in the second quarter?
So provisions are needed if you expect any losses or haircuts. On both these, we don't expect any haircut or any losses, and that I would like to clarify why. So our exposure to IL&FS is nil. Our exposure to IL&FS Financial Services is nil. These are the two companies which have defaulted. Our exposure to ITNL is also nil. Our exposure is to 6 road projects. 5 of them have been operating for quite some time, and 1 is complete project where COD has been applied for. So any further need from equity from IL&FS is zero. The entire, so out of these 6 projects, 4 are annuity, 2 are toll projects where there is a tolling record for 3 and 10 years respectively. The tolling records or the actual tolling is as per the projections. Our entire cash flow is trapped in a escrow which is totally controlled by us. Not only that, our entire repayment is on time, we also hold 450 crores in various reserve accounts, debt service coverage as well as major repairs, etc. In addition to that, out of this 1800, 720 crores around exposure is in IDF, which means that it is guaranteed by the government. So all this makes sure that not only our debt is safe, 100%, on top of it there is equity value in these projects, and hence when the sell-off, when the new management starts selling projects, probably these are the projects which will be sold first, and it can be a good refinancing and fee earning opportunity for us. So leave out taking any losses. We expect absolutely nil losses in any of these projects, and that's where our robust risk management model comes into picture. The story is very similar as far as Supertech is concerned. So our exposure is to 3 projects which are mid or late level complete. The sales, flat sales on this project, 75% average of flats in these 3 projects are already sold. Not only that, our repayment here is regular. So we are the sole lender, we control the entire escrow. Not only that, our repayment is regular, we have actually received 42 crores as prepayment in these projects. We are 1.98 times covered as far as receivables is concerned, and 2 times covered as well as asset cover is concerned. So all this we have disclosed for both these names very transparently, because we don't want any speculations to be on. So we have these exposures, but we are also sure, and you have the assurance, that the loss given default or any haircut that we have to take is nil on any of these exposures.
Okay. So then what about the asset quality outlook for the wholesale finance business?
At the end of first quarter, when we had to declare our gross stage 3 in wholesale finance, we declared about 5,058 crores in wholesale finance, which was about 12% or so. At that time, we gave an assurance that this is it. We have declared the whole thing, and from there, it will only come down. Right? I am happy that in the first quarter we have been able to keep this promise, and we say that we will keep this promise continuously. So my gross stage 3 from the first quarter to now has come down from 12% to about 10.9%, and net stage 3 has come down from 4.7% to about 4.2%. So the asset quality and wholesale is obviously, because of the legacy portfolio, the numbers are still looking elevated at around 11%, but 11% is better than 12%, which was there in the first quarter. So this is legacy portfolio. We have formed a separate group called Special Situations Group away from business to resolve them, and we are seeing the numbers, and over the next 1 or 2 years, we will see accelerated results in this. More importantly, since we have already completed the required provisioning on this, we don't expect any big hits to the P&L coming from this.